Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Welcome to the 3 in 10 podcast for Friday, July 31st. I am your host, Scott T. Slayton. This is episode number 65, and we are recording from Manhattan, New York at 11 a.m. Eastern Daylight Time. Here's your starting lineup. Number 1, reflections on the Fed post the meeting. Number 2, why we have turned tactically cautious on risk assets. And number 3, why we think gold is in trouble here. So back to number 1 on the Fed. And we have a bit of a defense of Fed Chairman Kevin Warsh. Yes, Warsh should have hiked instead of punting last Wednesday. We get that. In fact, we even previewed that in last week's pod. But the withering criticism of the chairman, in our opinion, is overdone. Warsh is asking for a little patience. We listened to every minute of the press conference. We understand that his tone was a bit patronizing, but we think he's right about markets tightening for the Fed. And we think he's reasonable in asking for some patience. I still believe he's fully committed to getting the inflation rate back to 2%, which will require tightening, and he knows that. Warsh is probably dealing with maximum political pressure inside the Fed with the staff and the other governors, one of whom really wanted his job. And he's probably also under pressure from the administration. We've never seen an administration that wanted tightening, and certainly this one does not. And they've been very vociferous about that. Let's give this capable man some grace. I strongly believe the Fed will tighten in September and probably December, unless the inflation data makes a dramatic turnaround, which I do not expect. So remember once again, the Fed follows the 2-year note, not the other way around. The chairman reinforced that on Wednesday. There is now a 70 basis point spread between Fed funds and 2 years, so they will be tightening. And let's all take a deep breath and be patient. Warsh at his core is a hawk. He is a hard money central banker. He is a free market central banker, and he will get there in time. And I do believe that inflation is a decision, and they have made the decision to return the inflation rate back to the 2% target. That's the important point. Now, number 2, why we've turned more cautious on risk assets, at least tactically. In our July monthly strategy report, we took a more cautious view in print. That was out this morning, very early, East Coast time. First off, our tactical equity strategy model has gone from what I would describe as maximum bullish in the spring to neutral, just flipped to neutral this month. Our tactical asset allocation model has been, in some form, bearish all year long. So 2 of our guiding light models are either neutral or bearish. We also know from history that we're heading into the weakest seasonal of the 4-year cycle. The August through October period of midterm election years has tended to be the weakest period of performance over that 4-year period, and we're heading right into it. We also know that financial liquidity, at least the way we grade it, has become much more challenging in our work. We have a dashboard that we put in our strategy monthly this morning, and only 1 of 7 indicators is now positive for liquidity. 3 are neutral, and 3 are outright negative and bearish. So that is a major change over the last several months for us. And liquidity is very important. It's a very important factor in our work. So despite the Warsh punt on Wednesday, we also believe the Fed is setting the stage to tighten. And We do not believe it is going to be one and done. We see a series of rate hikes coming. We think that is what is necessary to return inflation to 2%. And very rarely in history have you ever seen one and done tightening cycles. That just doesn't happen. So we think we're going to have more liquidity pulled from the market through Fed tightening. Now, I've also been looking technically at these AI and technology stocks, and some of them may have put in a short-term bottom this week with this unwind of the ironically named situational awareness hedge fund liquidation. But we see some very toppy stocks in the market, some very important toppy stocks like Microsoft, like Meta, and like Micron. Let's call those the 3Ms. Let's also discuss the SOX index, which also looks very toppy to us and has put in a parabolic rise just over the last several months. And of course, the Iran war is escalating and widening in scope. In our opinion, the bombing campaign has really reached the strategic limits of effectiveness. And we're locked in this unfortunate cycle of rhetoric, followed by kinetic activity, followed by negotiations, which ultimately failed because the two parties cannot agree on how the Strait of Hormuz will be operated in the future. And then we go back to kinetic activity and we escalate, which is exactly what's going on now. And we know that wars are inflationary. And there is still, when you listen to the energy experts, there is a non-zero probability of a real energy crisis, especially in products like diesel, jet fuel, and gasoline. That could be ahead of us. So we are tactically cautious on the S&P 500. We are strategically neutral looking out a year. And we're reiterating our long-held 7,420 target on the S&P 500. We have not been able to sustain above that level for any period of time this year. We laid that out in January as our target, by the way, and we still think that's the right target. Now, finally, number 3, why is gold in trouble here? Gold has already corrected sharply in 2026. In fact, it's down 27% from its highs made in January. But we're still worried about more downside for gold. Here's why. We think there's little doubt that gold experienced a parabolic blow-off in late 2025 and early 2026. Rising real interest rates are kryptonite for gold prices. Gold produces no income, so the opportunity cost of holding gold is rising. When you got a 2-year note at 440 and you're getting 0 yield on gold, that's an opportunity cost. It's an increasing opportunity cost. And while we still have a strategically gloomy view on the US dollar, we must admit it has stopped going down for now, and Fed tightening is supportive of a stronger dollar. 10-year TIPS yields at 2.5 and 30-year TIPS above 3 have become some real competition for gold. Once again, the real interest rate rising. Markets seem to have become somewhat inured of high policy uncertainty and wars. Gold did its job in 2025 when policy uncertainty was at the extreme. It doubled. It more than doubled in 2025. So technically, I can see 15 to 25% more downside to gold from here to around 3,300. I think that would erase the blow-off that happened in the second half of 2025 and early 2026. And I'd probably be a buyer at 3,300 because the structural problems of debt, deficits, deglobalization, and de-dollarization will be with us for years to come. And global central banks will be buyers of gold probably for years to come. But in the meantime, if you're a long-term holder, expect more downside. Maybe you sell some calls, maybe you buy some puts. But in the end, do the work, endure the fog of Warsh, and have investment prudence.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.